You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. This is your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, well, we are slowly getting into the earnings season here in 2020. So at the end of the month, we have a lot of the technology stocks, a lot of the FANG stocks that are going to be announcing earnings. So, as usual with Options Playbook Radio, we like to look at trades around earnings. Options Playbook is made up of 40 different strategies. We talk about the calls, we talk about the puts, and one of our biggest things about Options Playbook Radio is not trying to make a forecast on an underlying stock. We're just here to learn about the strategy. So everything we do is meant to be just a paper trade and just to learn a little bit about option trading. So, the most recent, if I'm looking at my little watch list of earnings that are coming up here over the next couple of weeks, I do see McDonald's on the list. And one of the reasons why I like to talk about McDonald's this week is because it is a $210 stock. As a matter of fact, I should probably mention that we are taping Options Playbook Radio on January 15th. The markets are closed. McDonald's closed at $209.77 today. It was up $2.45 on the day. So McDonald's overall has made a fairly decent run, and it's had a little bit of volatility in the underlying stock. Just recently, it has made, let's just say back a couple of days ago, it made a 7-point run overall in the marketplace. It opened at 200, closed at 207 on that day. And now we just kind of have the stock being up a little bit, and I think a lot of it has to do with just the earnings and everything that's being announced around McDonald's, the fact that we are in the earnings season. So we know that they're going to be announcing on the 29th, and I'm going to look at doing something a little different on McDonald's. I think the stock will actually kind of settle down a little bit going into the earnings, so we're going to look at using a butterfly as an at-the-money butterfly specifically to try to take advantage of time decay. So a lot of times we're doing butterflies, we're trying to take advantage of high volatile situations that we think will come in. So we're either looking at doing way out-of-the-money skip strike butterfly for a net credit. We've talked about those. Those are one of the more popular trades on Options Playbook Radio. So to try to do something different before we get into all these fancy tech stocks announcing earnings and looking at 200-300 point moves, let's just look at McDonald's. McDonald's after earnings right now, if I just look at the long spread or long straddle in McDonald's with the January 31st expiration. So like I mentioned, stocks right around 210. The most at-the-money call and at-the-money put and the January 31st expiration, 2 days after they announce earnings, is trading for $7.20. So if you're thinking about that, it's made those type of moves recently, and the volatility on the front month option contracts are a little bit lower. So I'm kind of thinking that it might settle down and wait until this earnings, but a 7-point move doesn't really seem like a very big move in a $200 stock after earnings. So to go into earnings, let's go in and do a long butterfly with the intent of the stock just staying within the range leading up to earnings. So this is going to be about a 1-week trade. We're going to look at the expiration that does not contain the earnings. And so the expiration that does not contain the earnings is the January 24th expiration. That is 9 days away. If we do a 5-point wide butterfly, which will basically give us a 10-point range in McDonald's, 5 points to the upside, 5 points to the downside, that butterfly with the January 24th expiration is currently trading for $2.38. We're going to do it 5 points wide. That means the maximum that this could trade for would be 5 points. And we're just kind of hoping that McDonald's will hang within this range and kind of settle down as far as the volatility is concerned going into earnings. So here's the official trade. It's going to be a long butterfly spread with calls. That's where you're going to find it inside the options playbook. We're going to look at the January 24th expiration, which as of today has 9 days to go until the expiration of those option contracts. We're going to buy the 205 strike call, and we're going to sell 2 of the 210 strike call, and then buy 1 of the 215 strike calls. 5-point wide butterfly. Right now I'm showing the midpoint of that trade at $2.40. So if we do this trade, that's going to be our maximum loss, is that $2.40. We hope the stock stays within the range. Now, the break even, if you ride it all the way to expiration, is going to be $2.05 plus that debit of $2.40, or $2.0740 on the downside. Or on the upside, you want to take the upside strike, which is $2.15, and subtract out that $2.40, which means on the upside, where the range you'd like to stay in is $212.60 within this expiration date. So our whole goal here is to try to get some time decay. By next week, by Monday or Tuesday, we're going to see a large rate of decay in these option contracts. The 210 strike option contract is still trading with quite a bit of premium in it. We have it trading for $1.50 on the 210 strike. We know that earnings are coming. Earnings are coming the week after. And for example, the implied volatility has gone up quite a bit. If we look at the same strikes for that expiration 1 week out, and we're talking about the 205, 210, 215, but we're looking at the January 31st expiration, well, that actual option trade is trading for $1.16. So it's interesting to see the difference in volatility. We're talking about a 12% volatility versus a 20% volatility between the January 24th and January 31st expiration. So this is a little bit different. We haven't really done a butterfly to just try to take advantage of time decay on this trade. And with McDonald's having such a big run-up and being so volatile going into earnings, we're just kind of hoping, our forecast is that the stock will kind of just settle down before that earnings announcement, and that's what our total goal is here. So if I look at the McDonald's trade, once again, let's go back and recap exactly what we'd be doing. So we're going to be looking at doing a long call butterfly spread with the January 24th expiration. We'll be buying the 205 strike call. We'll be then selling 2 of the 210 strike calls, and then buying 1 of the 205 strike calls. So if we're doing this trade, we are looking for McDonald's to just stay flat going up into earnings. We're going to put this entire trade on for a net debit of $2.38 to the account. And if we can sell this and get out of this trade, if you ever do this type of trade, we're really just looking for time decay. If we can make it through the weekend, we should have a great amount of time decay on these option contracts. And if we put this trade on for $2.38, if we could get out for anywhere around $3, if it stays anywhere within our range, within our strikes, that potential is there. I'd look to try to trade out of this if it goes about 70 cents higher. And then also on the downside, if we do get a move in either direction, we do want to close it out. If it gets anywhere close to our long strikes, the 205 strike call or the 215 strike call, well, that's also one we're going to trade out. Or you could do it via price. You can say to yourself, well, if my goal is to make 70 cents on the upside, I also am willing to get out if I'm losing 70 cents on the downside. You got time decay on your side. Time decay is your friend in this instance. The stock, if I actually look at the long straddle, the 210 strike call and 210 strike put, if we were to buy that with the January 31st expiration, the total movement that you're looking at there is $7.20, and that's containing earnings. So that's where the expected move is at. So we're going to look to do this trade, hoping that McDonald's settles down. And then based off of what McDonald's has done, if I were to go into earnings, I would want to do look at a trade that would have more volatility as opposed to less volatility, considering that the expected move just happened a couple of days ago. That $7 amount actually happened from open to close just 2 days ago in the trading session. So a little bit something different, focusing on a butterfly ahead of earnings, looking for time decay as opposed to doing the butterfly after earnings and looking to do it directional and trying to pick a direction. That's going to be it for this episode of Options Playbook Radio. If you have any questions you'd like to ask me, please email them to me at theoptionsguy@invest.ally.com. I want to say thanks for listening, and we'll be back at the same time, same place next week.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.